So far we've looked at two different types of investing. On the one hand, there's active investing, actively trying to beat the market through stock selection and market timing. This is often referred to in the industry as trying to generate alpha. On the other hand, there's passive investing, simply trying to capture market returns, often referred to as beta, at a much lower cost. But there is a third way, a sort of halfway house between active and passive. It's called factor investing. Sometimes referred to as smart, strategic or alternative beta, factor investing is based on the Multifactor Model developed by two American academics, the Nobel Laureate Eugene Fama and his colleague Kenneth.
The Multifactor Model took the equity returns of stocks and carved them up into slices, basically looking at the size of the companies and a value growth metric. And so by dividing up the market into these slices and looking at the returns of these different slices, academics, and primarily Fama and French, uncovered that there had been higher returns among small companies and among value companies. And then when you blended that, you even had a combination of these factors for even higher returns.
So, the original Fama-French multi-factor model included three types of risk: market risk, the size factor, and the value factor. They later added profitability. In other words, more profitable companies tend to deliver higher returns over time. Academics have also identified two primary factors driving fixed income or bond returns. The first is term premium, that is, bonds with distant future dates have returned more than bonds that are due soon. And the second is credit premium, i.e. bonds with lower credit ratings have returned more than bonds with higher credit ratings.
We don't think that investors are suddenly going to stop demanding differences in expected returns to hold different stocks. We think it's very unlikely that every stock in the world will have the same expected return at some point in the future. Unless that happens, you're always going to have size, value, profitability premiums. But what changes, how you go about identifying who's low relative price and how you go about identifying who has high expected cash flows. And those things evolve as accounting practices evolve, as data evolves, as you get better and better data. Those things evolve, but the underlying principle of the three-factor model and the five-factor model, which has been around for hundreds of years and will be around for hundreds of years in markets.
Seeking exposure to different risk factors is known as tilting your portfolio. So, are factor tilts a good idea? Factor-based funds are slightly more expensive than conventional index funds, but if you're willing to be patient, then yes, they can make sense. What you have to remember about these different factors is that although they are expected to deliver higher returns, there is a price to pay in the form of greater risk. Many investors are simply too impatient. They expect outperformance far more quickly than is reasonable.
Any of the smart beta strategies work on their own over a reasonable period of time. But to think that you're going to beat the market over a 1, 2, 3 year period is really misunderstanding what the products do. So if you can build a portfolio that you could stick to, that's probably more important than the strategy itself, whether you want to equal weight them, tilt to value, to whatever you're comfortable with. But I think one of the issues is that people that had been chasing the mutual fund managers might experience similar behavior with these smart beta products. So I think that's therein lies the danger.
Some say there's another danger, that factor investing is becoming too popular. As more and more people tilt to different factors, might the premiums that those factors are expected to deliver disappear?
So what you could very well see is a form of an observer effect, whereby people crowd into, say, the value factor through one or multiple funds that set out to exploit that value factor. And by doing so, they squeeze out any excess performance that might have existed in there. Now, ultimately, what I think you will see is that behavior will take hold. that people are still people, and that newly minted value investors will get fed up with market-like or subpar performance. They will go out of that fund or that factor as quickly as they entered it, and value will magically reappear.
So, when deciding how to invest, the most important thing is to avoid high-cost, actively managed funds. The evidence clearly shows that the best approach is a combination of passive investing and factor investing, sometimes known as evidence-based investing. By choosing the evidence-based route, you're far more likely to have a successful investment experience. It's essential before you make any investment that you fully understand any risk you might be taking.
Probability of a permanent loss of capital from investing in major markets is very, very, very low.
But take the example 20 years ago. If you had picked the market that was in vogue at the time, namely Japan, you would have lost 75 or 80% of your money.